So I decided that if I'm going to talk about investments and stocks, that I should probably be accountable and show how I've been doing over the past year. The goal of my strategy right now is growth and to beat the S&P 500, which is quite difficult to do. I'm also showing you this on a day that's actually in the red for both me as well as the S&P 500, so that you can see I'm not just depending on one big day of growth to actually be beating the S&P 500 in the last year. So as you can see right now, I am down 0.77% today. The S&P 500 today is actually down 0.39%. Now, if you look at the past year, the S&P 500 is up 11.91%, and I'm up around 13.24% in the past year. So not necessarily beating the S&P 500 by a lot. Before this new administration, it was by quite a bit. But now, of course, the margins have narrowed. It's been a crazy year, as we all know, and pretty much anything positive is almost a miracle at this point. But I actually have about 14 stocks that I've bought and that I still hold right now, and 11 of those have been positive. Now, 3 of those have gone negative so far, and there's a few lessons to be learned there. So one that I've had that is in the negative since I've bought, actually down about 36%, is AMD. AMD has been jokingly called on Reddit Advanced Money Destroyer. So Advanced Micro Devices has actually done really well lately. In the past month, they're up almost 33%. But if you look at the last 6 months, year to date, the past year, they've had a lot of trouble. One thing that's kind of scary about them right now, even though they had a surge over the past month, is their PE ratio is still very high compared to their growth. So some people will tell you, well, you should only get stuff with a low PE ratio around 20. And then some other investors might tell you, well, you should compare the PE ratio based on their growth, because different sectors have different amounts of growth, and you can't treat all of them the same with the same 20 PE ratio. So I'm not going to get in too much in depth about that. But one thing you can look at as an indicator, if you're one of those believers that you look at the PE ratio based on their growth, it's still not that good. If you look at the past year, they're down 31.76% in the past year, and they have a PE ratio that's still really high at 83.21. Now you might say, well, over the past 5 years, they're up 105.75%. But if you do 105.75 divided by 5, they're averaging growth of 21.15% per year, which is also way lower than their PE ratio is right now. Now you could make the argument that some of the recent news, which is part of the reason AMD stock went up, not just because of their solid financials, but because Amazon acquired an $84.4 million stake in AMD amid AI chip expansion. So you see something like that and you're like, wow, that's very encouraging. But they're always going to be kind of considered the second fiddle to Nvidia, unfortunately. So even though I think they're a great company, it's one of those that maybe looking back, I would not have bought, not just because of how it's gone now, but if you look at their numbers lately, it's like I would not really, even with that news, I would not really encourage buying more of AMD. Am I going to sell? I don't know yet. I'm still kind of waiting to see how some things play out with tariffs and all of that right now. But if you were to even just look at one of the basic foundations of buying a stock, and you look at the PE ratio versus what type of returns you might expect from AMD, for one, they'd have pretty much no dividend yield, and you're looking at really just going all in on growth if you're buying AMD, which is down again almost 32% in the past year and is only averaging about 21.15% gains over the past 5 years while having an 83 PE ratio. That's not great. So it remains to be seen whether or not this Amazon deal and their financials can actually help them start turning things around. But it seems like people are always predicting AMD to turn around, and it just hasn't really come to fruition yet. Another stock that I have that's been down is Qualcomm. Qualcomm has a year-to-date growth of, it's basically broken even. It's basically about where it started. It's only up 0.12% in the past year, or should I say year to date, which a lot of stocks, if they're positive at all after all this tariff up and down stuff that's going on, that might be a good thing. But in the past year, they are still down 22.22%, even though a lot of stocks were doing extremely well last year. They were not doing so well last year. Now, if you look at the last 5 years, 95.45% over the past 5 years. So you're looking at an average return of around 19.09% over the last 5 years for Qualcomm. So that being said, they have a PE ratio that's actually pretty reasonable. It's at 15.67%. 15.67, I should say, not really percent. But then you also add in a really nice dividend yield of 2.31%. I like to kind of put those together when you're looking at how much you're really earning. Even if it's a stock you're mostly buying for growth, if they add a dividend yield on top of that, I like to add those kind of to the PE ratio to better evaluate what I'm really getting out of something. So if you were to do that, you'd be at, say, 17, almost 18 on the PE ratio, which is actually very close to what they've averaged over the past 5 years if you're looking at the PE ratio compared to the percentage return. So that being said, even though Qualcomm is down over the past year and hasn't had incredible returns over the past 5 years, in general, they've done okay, steadily rising for the most part. And because of their really low PE ratio, their business model, which actually deals a lot with things that I really don't think are going anywhere right now. Like if you look at wireless telecommunications, you look at chipsets that are used for smartphones, which aren't going anywhere anytime soon unless we start implanting chips directly in our brains. You look at automotive systems. You're talking about a company that should be okay. They may not be the best growth stock right now. I don't know if I would recommend people buying them necessarily, even though they have a really nice PE ratio and a really nice dividend yield right now. Right now, they're on more of a wait and see trajectory as far as maybe not ready to give up on them yet or to not buy more yet. But I would say just maybe I'm going to hold a little longer, see how they do. But they're one of the few that actually has not done very well for me over the past year. Another one that I've somewhat regretted buying is Amazon. Believe it or not, I thought Amazon, if you asked me a few years ago, I'd be like, yeah, having any Amazon stock would be great. Amazon is like a bulletproof stock, and a lot of people probably feel that way. But if you look at how they're doing, year to date, they're down 7.33%, even despite the surge since some of these tariff deals have been made. If you look over the past year, not looking that good, really, especially from what you would probably expect from a company that has literally changed the world. 11.19% over the past year. And then if you look at the past 5 years, actually only 67.49% return in total over the past 5 years. Their PE ratio is a 33.28, which isn't super high necessarily, but also they have no dividend yield. So you're looking at you're getting this stock specifically for growth. You want to get some growth out of this. You're not looking to, live off of dividends from Amazon or anything like that. This is one of those stocks you might want to buy early on and let it grow for a couple decades before you turn it into dividends later on. But Amazon is just not getting as much growth as I would like to see. If you look at what percentage they are getting on average over the last 5 years, 13.49% essentially average return per year over the last 5 years for Amazon. You're looking at 13%, but the PE ratio is more than double that. And you're looking at the past year. Does the past year show a lot of promise? Well, not really. It's pretty much more of the same. How's it doing year to date? Not good. We are 5 months in, almost 6 months into 2025. Obviously, most stocks are probably not doing as well as they thought they would do this year. But a lot of that is because of all the news about tariffs and the slowing economy and things like that. So a lot of stocks are not going to look that good on the year-to-date charts. But that being said, there's been quite a resurgence over the past month or so and they are still, I mean, they're still down 7.33%. I'm not necessarily judging them on that. It's more about how have they done the past year, how have they done over the past 5 years, and it just doesn't look that great if you're really looking for growth. I mean, they could be maybe steady growth, maybe, but if you're looking at, you're only getting maybe 13 or 14%, when if you look at in comparison to what you could have put that money into Nvidia or Meta or JP Morgan Chase or Progressive or Constellation Energy, these other stocks have done so much better. Even though you look at Amazon, you might think, well, they're pretty much bulletproof. There's no way they're going to just, like, who's going to beat them? Of course, their sales might be affected quite a bit by these tariffs, depending on how some of these deals fully shake out by mid-July. So that was just one thing I noticed, that some of these the 3 stocks out of the 14 that I own right now that have not done very well growth-wise, even though some of them I haven't owned but maybe a year or a little less than a year, if you look at some of the things they all have in common as opposed to the other 11 stocks I own, that was one thing that really stuck out, is the PE ratio versus the percentage return over the past year and the percentage return on average over the past 5 years. All 3 of the stocks that I've bought that have not been profitable pretty much have all of that in common. Qualcomm is very close to being at the right level of, if you're comparing the PE ratio versus their return over the past year and over the past 5 years, but they're still a little bit below, especially if you do over the past 5 years. So they all have that in common. Is that something that maybe could be an interesting indicator going forward? I'm definitely going to look at it like maybe one indication. Of course, there's no one size fits all indicator in stocks, and this is, of course, not financial advice in any way, but it's something you might want to think about. Maybe do some of your own research on that. And of course, I will try and consider that, as well as, of course, many other factors going forward when evaluating stocks and hoping to continue to beat the S&P 500.